Every business owner wants more profit, but most are measuring the wrong things, leaving money on the table. What if a single metric could double your growth rate? Companies with high NPS scores grow at twice the rate of their competitors. This isn't about happy customers. It is a direct line to increased revenue and market dominance. Your biggest fans, your promoters, generate substantially more revenue and are far less likely to leave than your critics. Today, we'll reveal the KPIs that truly drive profit, covering customer value, internal efficiency, and the critical mistakes to avoid. If loyal customers are so valuable, how do you track their total worth? The first pillar is understanding customer lifetime value, or CLV. But CLV is only half the story. You also must track what it costs to get that customer in the first place, your customer acquisition cost. Ignoring your CAC is a fatal error, because acquiring a new customer is 5 to 25 times more expensive than keeping an existing one. This is why metrics like website traffic or social media likes can be so misleading. They feel good, but they don't show the real cost. A true KPI is not just a number, it's a guide. It must be directly tied to a strategic goal, like increase profitability by 10%. We know we need high CLV and low CAC, but what is the perfect profitable balance? There is a specific number you need to hit. That number is the LTV to CAC ratio. For a sustainable business, the goal is 3 to 1. For every dollar spent, you need $3 back. Why 3 to 1? A 1 to 1 ratio means you're losing money after operating costs. A 3 to 1 ratio gives you enough margin to reinvest in growth. But even CLV can be deceptive since it tracks revenue, not profit. Advanced businesses track customer lifetime profit for a true bottom-line view. Now, let's look inside your business. Your ability to deliver value to customers is directly linked to your internal efficiency. Are there hidden costs inside your company that are silently killing your profits? Let's examine one of the biggest offenders, employee turnover. Losing an employee is a major financial event. Replacing one person can cost 50% to 200% of their annual salary when all costs are tallied. And that's just the direct cost. You also lose institutional knowledge, and productivity drops while new hires get up to speed. For businesses with physical products, another profit killer is stagnant inventory. Your inventory turnover ratio measures how fast you sell stock. A healthy ratio is typically between 5 and 10. This means you sell through your entire inventory every 1 to 2 months, optimizing cash flow. Here's a metric most businesses ignore: profit per employee. This shifts your view of employees from costs to revenue drivers. So you have powerful customer and operational KPIs, but your entire strategy can collapse if you fall into a few common traps. We mentioned vanity metrics before, but let's be clear. 1,000 likes are worthless if they don't lead to a positive LTV to CAC ratio. First mistake: tracking too many things. Information overload leads to paralysis. Focus on 1 to 3 KPIs per strategic goal. Profit on paper means nothing if you run out of cash. A metric like days sales outstanding is vital. It tracks how quickly you get paid. This is why a simple P&L statement is not enough. DSO predicts future financial health, while profit is a lagging indicator of past performance. You can pick the perfect KPIs, track them religiously, and still fail. What is the single biggest mistake that renders all this work useless? Before I answer that, let's connect the dots. Recall the high cost of employee churn and the immense value of high NPS customers. These are not separate issues, they are a feedback loop. High employee churn destroys service, which craters your NPS score and kills your CLV. This is why profit per employee is such a powerful synthesis metric. It forces you to see the link between investing in your team and customer profit. Understanding these connections is the key to a truly profitable strategy. Now, let's answer that final question. The single biggest mistake in tracking KPIs is failing to act on the data. A dashboard is useless decoration if it doesn't lead to decisions. So, to increase profitability, you must master 2 areas: customer value, by obsessing over your LTV/CAC ratio, and operational efficiency. Tracking these isn't about data. It is about making informed, profitable decisions. That's how some companies grow at twice the rate of competitors. Your task is simple. This week, pick one KPI we discussed. Measure it, understand it, and make one decision based on it. That is the first step.